Welcome to The Explainer. Today we are putting on our financial detective hats to investigate the true health of Commercial Metals Company, or as it's better known, CMC. We've got a mountain of raw data in front of us, but our job is to sift through all that noise and figure out exactly what the numbers are really telling us. Let's dive right in.
Now just look at this massive number. We're talking about CMC's incredible 10-year total return of over 363%. When you see a figure like that, it immediately screams historic winner, right? I mean, for the past decade, this company has richly rewarded anyone who just bought and held. And it's not some flash in the pan either. Their 15-year return is even higher, clocking in at nearly 495%. But, as we all know, past performance is just our starting point. We really need to figure out what's happening right now. So to solve this financial mystery, here is our roadmap. First, we'll meet CMC, then look at price versus value, track their profit and growth, check out dividends and financial health, and finally, wrap it up with the bottom line.
All right, Section 1. Let's officially meet Commercial Metals Company.
So, what kind of giant are we investigating today? Just to establish our baseline, CMC is a major player with a $7.6 billion market cap, trading right near $69. Notice that 52-week range there. They hit a low of around $44 and then bounced back up over 54% from that bottom. Pretty impressive. However, year-to-date, the stock is basically flat at just a 0.19% return. It's kind of just holding steady right now, catching its breath.
Moving on to Section 2. Valuation. Price versus value.
Now, here is where we encounter our central conflict. The market is currently pricing the stock at roughly $69. But if you run a discounted cash flow analysis to calculate the present value of the cash the company is actually expected to generate, well, those underlying cash flows suggest a fair value price of only $57.22. That is a rather uncomfortable gap, wouldn't you say?
And that discrepancy creates a margin of safety of negative 20.51%. Let that sink in for a second. The price tag on this stock is roughly 20% higher than the company's calculated intrinsic value.
Just to make sure we are all on exactly the same page, a margin of safety is basically your fundamental buffer against calculation errors or unexpected market downturns. You generally want this to be positive, buying a dollar for 80 cents. But here, a negative 20% margin means you are effectively paying $1.20 for that exact same dollar. So yeah, you're paying quite a premium.
Okay, Section 3, tracking profit and growth. Let's look under the hood.
If we're going to pay a premium, we really need to find some solid evidence of spectacular growth to justify it. Well, this chart is wild, and you really have to pay attention to the time frames here. It shows this massive recent spike with a trailing 12-month net income growth of over 590%. Absolutely incredible, right? But hold on, because that recent explosion completely masks a rather concerning medium-term trend. Just look at the 3-year average. Net income actually shrank by over 21%. So things have been highly volatile before this sudden skyrocketing.
And we see a very similar pattern with their top-line revenue. Look at the bookends. You've got consistent 8.3% growth over the last single year, and that exact same 8.3% growth stretched out over a 5-year timeline. But right in the middle, there's a really noticeable dip. The 3-year average sits at negative 2.92%. So top-line sales dipped in the medium term, just like the bottom-line profits.
This evidence shows us exactly why that negative margin of safety exists. The market is highly optimistic right now. They're pricing the stock based on these massive recent spikes while essentially ignoring the struggles of the last 3 years. Investors are basically making a bet that this recent explosive growth is the new normal.
Let's turn to Section 4, dividends and financial health. So if the growth is erratic and the valuation is steep, what exactly is the company's alibi? Let's take a close look at their safety nets. While a 1.16% dividend yield might seem a little modest to income-hungry investors, just look at their payout ratio. It's an ultra-low 16.26%. That means they are paying out just 16 cents of every dollar earned, keeping the vast majority of their cash to reinvest or just cushioning against hard times. Add in 5 consecutive years of increases and a 5-year growth rate of over 10%, and you've got yourself a highly sustainable, growing dividend.
Furthermore, these core health indicators confirm that CMC really does rest on a rock-solid foundation. They boast a low debt-to-equity ratio of 0.76, meaning they rely way more on their own equity than on borrowed money. And that current ratio of 2.38,
That's a critical liquidity metric showing they have more than twice the assets needed to easily cover all their short-term liabilities. They are sitting in a very sturdy defensive position.
Which brings us to Section 5, the bottom line.
All right, we have thoroughly investigated the numbers, and frankly, we're looking at a classic tug of war. On one hand, the bullish case is incredibly strong. We've got a historic market winner with incredibly safe debt levels, plenty of liquidity, and reliably rising sustainable dividends. But the bearish reality cannot be ignored. This is a stock trading at a clear premium, fundamentally overpriced, with a negative 20% margin of safety and possessing some undeniably erratic medium-term growth metrics.
So, the ultimate question I want to leave you with today is this. CMC clearly has an impenetrable foundation and they are actively returning cash to shareholders. But are you willing to pay a 20% premium price tag to own a piece of it right now, or do you add this fantastic company to your watch list and wait for the market to give you a better margin of safety? That is the mystery you get to solve for your own portfolio. Thanks for diving into the numbers with me on this explainer today.